Top recession-proof dividend stocks. With inflation and interest rates rising, 2022 hasn't been the year for stocks. American stocks have been particularly affected by this bear season, as most haven't fully recovered from the COVID-19 recession and rising interest rates impacting stocks. However, with the stock exchange in a period of economic decline, some stocks have been resistant to this recession and have continued to thrive. On this channel, we've made it our utmost priority to come up with stocks that can change your lives forever, make you financially independent, and allow you to live the life of your dreams. That's why in today's video, we will share with you 5 top recession-proof stocks that we think will do well and continue to perform even if recession hits. These incredible stocks were picked after careful analysis, and we're confident you'll enjoy our picks. If our content has helped you in one way or another, make sure you hit the like and subscribe buttons and stay until the end of this video because we think you'll be blown away by our last pick, Pfizer PFE. The first stock that we will talk about today is Pfizer. The coronavirus pandemic really brought Pfizer to the limelight as one of the companies that worked tirelessly to find a solution to the virus. Pfizer is one of the world's premier pharmaceutical and biotechnology companies, specializing in the manufacture of stock, pharmaceutical drugs, and vaccines. PFE tops the list of our recession-proof stocks today because of the company's importance and relevance at every point in time. People will always buy drugs, no matter the economic conditions. COVID-19 was a blessing in disguise for the stock, as its price soon skyrocketed after the pandemic. The reason for this is not hard to see, as Pfizer was the first pharmaceutical company to develop a vaccine with about a 95% success rate against symptomatic COVID. Although the company's stock was down to around $27 at the peak of the pandemic in March, it soon picked up as the vaccine was in high demand. By December 2021, the stock's price will have reached an impressive high, close to $60. The stock has maintained this price range despite the recent economic decline and stringent financial measures that have made most stocks a shadow of their former selves. Pfizer is one of the top recession-proof stocks available today because of its stable financials and strong business fundamentals. Since COVID is entering its endemic period, the company might not generate as much profit from its COVID franchise as it has done in previous years. However, the company has a well-detailed plan for the potential approval of several drugs, making the long-term investment worthwhile for potential investors. Looking at the stock's numbers, it is not doing badly either. With a dividend yield of around 3% and an average 5-year yield of more than 1%, Pfizer is trading around its average dividend yield of just over 3%. What is the company's dividend payout with these dividend yield values? The company has consistently paid dividends for 33 years now. Slowly but consistently, the company has grown its dividends for 12 consecutive years. The stock's EPS growth rate over the past 9 years has been pretty good, with a 12.8% growth rate. According to our conservative analyst estimate, the EPS growth rate will be around 5% annually in the next 5 years. Analyzing how the dividend grew, PFE's dividends have grown by over 6% in the last 9 years. Over the next 5 years, we expect it to grow around 1% annually. Pfizer's best year in terms of revenue was 2021. The company also recorded a significant increase in its return on invested capital that year, from 9% the previous year to around 20% in 2021. This is a good figure for the company as it averagely returns over 12% for every dollar invested. Our model predicts that Pfizer stock could see a whopping 14.6% annual returns over the next 5 years. This is based on several metrics which so far have been positive. With a conservative EPS growth estimate of around 5% and a dividend yield of 3% annually, PFE is looking like a good deal. Since Pfizer stock is experiencing a price reversal after its October lows, now may be the best time to add the stock to your portfolio. Home Depot, HD. Next up, guys, is Home Depot, which has made it into our list of recession-proof stocks in our video today. Home Depot stock is one that easily comes to mind when talking about stocks that can generate profit even in times of recession. Home Depot is the largest home improvement retailer in the United States, selling tools, construction products, appliances, and services. The company grossed around $151 billion in total revenue in 2021. The company has over 490,000 employees and over 70 distribution centers in the U.S. In the second quarter of 2020, the company reported huge returns on the sales. The company made around $38 billion, a 23.4% growth from the result of Q2 of 2019. This culminated in a total of around 27% increase in profit that same quarter. The effects of this huge increase in profit due to more sales also tricked down the company's stock as it went on a strong bullish run all through 2021. Priced at around $180 in March 2020, the stock price soon rallied to around $415 per share in December 2021. HD stock now trades at around $327. The nature of HD services, which puts the company in high demand all year, is a major factor that has made the company recession-proof over the years. This unique company's visionary strategy and expansion initiatives into the pro market through its flatbed distribution centers, FDC, and delivery of heavy and bulky goods have kept the company relevant and above its competition. This further reinforces our position on why we think Home Depot is a good stock that you can add to your investment portfolio. Looking at HD stock values, the stock has done pretty well these past years. The dividend yield has been pretty good, standing at around 2.4%, slightly better than its 5-year average yield of 2.2%. The payout ratio is also normal at 45%, meaning the company does not look like it will be cutting its dividend anytime soon. The company has paid dividends for 21 years and has grown its dividends for the past 13 years. Even though the company might seem to be an old world retailer, its growth over the past few years has been solid. It boasts a 20.5% EPS growth rate and a 23% annual dividend growth rate over the past 9 years. Based on our conservative analysis, over the next 5 years, we predict that the EPS and dividend growth rate will grow annually at 7% and 9% respectively. Over the years, Home Depot has been very profitable with steady revenue growth. The return on invested capital increased from 14% to around 40% in a 10-year period, averaging 27.6% during this period. This figure is by far greater than the general market of around 10%. Going by our conservative model, we estimate that HD stock, currently valued at around $318, could see a return of over 10.6% annually over the next 5 years. Considering how the company's ROIC has improved, it is one that is worth your research if you're looking for a recession-resistant stock. Dollar General, DG. Last but not the least stock we will be bringing to you in today's video is a company that is quite popular for the wide range of products it offers and for being a discount retailer. This is none other than Dollar General. DG is an American chain of variety stores where you can buy home decor, clothing, grocery, pet supplies, cleaning supplies, and other seasonal items. This company is no stranger to the average American, as you've probably shopped from one of DG's stores at least once. As a discount retailer, the company maintains its profit and demand during the recession as consumers keep their patronage as a means to save costs. Undoubtedly, Dollar General has been one of the market's strongest stocks post-COVID with a massive run. The reason for this absolute tear is clear. The recession made the company the spotlight of the retail industry due to the low price of the company's products. Before COVID, DG was trading at around $160. At the peak of the COVID crash, when the global market tanked, DG only experienced a slight decline as it dropped by around 10% to around $140. As the pandemic ended and the recession set in, the stock's run was crazy, peaking at around $260 in October this year. The stock is currently priced at around $240. Let's take a quick look at the company's financials. The stock's dividend yield is currently less than 1%, but still better than its 4-year average of 0.7%. With a dividend payout ratio of 20%, the company is almost certain to keep paying dividends. The company also has a fair history of dividend payments, having paid dividends for 7 consecutive years. DG's dividend has also grown consistently over the last 5 years. Going over Dollar General's earnings per share growth rate, we can see that EPS has grown by over 21% in the past 9 years, and we project it to grow at an annual rate of 7% over the next 5 years. Dividend growth has not been consistent over the past decade, but it has stabilized in the last 5 years. In the next 5 years, we, however, estimate an annual growth rate of 9% for the stock. Last year was great for Dollar General as the corporation made over 26% return on invested capital. This was largely due to improved sales recorded in the year. Even though this explosive return might not occur this year, with an average of around 17% ROIC, this is more than the market's average of 10%. Considering the stock's previous performances in periods of recession where it gained, our conservative model estimates that it will also stand the test of this current recession and come out stronger. Although bears think this stock is slightly overpriced, we think its pricing is decent for a stock that is projected to see returns of about 15% annually over the next 5 years. Now may be a great time to consider the stock. So guys, that brings us to the end of our video today. Thank you for watching till the end. Let us know your favorite recession-proof stocks in the comment section below. If you haven't subscribed, make sure you destroy the like and subscribe buttons, and we'll see you next time.